All right, we are live. It is the top of the hour, 3 p.m. UTC. Welcome to this very first Deribit live session. This is going to be a lot of fun. I'm Shane Oglow along with Richard Hodges, and we're just going to wait a few minutes. Let some people join us. I realized the waiting room little blurb had that Latin in there. Sorry about that. Hey, we're traders. We're not web marketers, right? So let's just hang out for a minute. Wait for some more people to join us. We got a few coming in. But while we're waiting, just get you guys familiar with the interface if you haven't used this before. You got the chat function. So if you want to tell me where you're from, where you're tuning in from, that would be awesome to give us a good idea of who we're talking to and what time zones. And if everyone can hear me, I should have said that first. If you can hear me, please put yes that you can hear me okay. South Africa, the Netherlands. Oh, there's Antoine. Hey, Antoine, how you doing in Dubai? Oh, UK. I got some Ukrainians right on. I was just in Ukraine a month and a half ago. I love that place. Oh, Panama, right on. Yep.
Wow. Global audience.
Yeah. The problem is when you're worldwide, there's always somebody who has to kind of be up really late or really early in the morning, and it always sucks when you're the odd man out. But Czech Republic, wonderful.
There's someone showing their age.
Yeah. Pierre. Oh, Tasha, our friend Tasha, also here. I'm in Andorra right now, by the way, but my partner Richard's, he's actually in Dubai right now. So we're split up too. We got some Russians here. Excellent. Konstantin, welcome. Is the session recorded? Yes, WJ, the session is going to be recorded. I sure hope so. We've new software. First time we've used it, but it automatically records. And the good folks over at Deribit will be posting this replay. I don't know exactly when or how they're going to do that, but it will be recorded and it will be reposted at some point.
Are we going to put it on our YouTube channel as well, Shane?
I'm not exactly sure. I think we'll have to talk with Deribit. So, okay, we'll just give it another minute or so. We got more people joining us.
Wow.
Excellent.
That's impressive. I see 89 people now. What was like a week's notice or less than that?
Yeah, no, I agree. This was done on pretty short notice. We're super pumped about it. Let's see here. We got one more 90. Yeah, we'll tell you what. When we get to 1704, we'll just start. We'll go live. Hey, Eddie.
You're on different times.
All right, another 30 seconds here, and then we'll get going. Orange hat. Orange hat. I would expect Orange hat to be from the Netherlands, but Brazil, Portugal. So how can you be Brazil, Portugal at the same time?
I think a few of them think it's the same country.
Yeah. I don't know. All right, I think we've probably waited long enough. Let's go. We got people joining later. That's fine. They can join in later. All right, so welcome everyone to this very first Deribit live session. We are the Rogue Traders. We're doing this in conjunction with the good folks over at Deribit. We've been using Deribit for ages to trade crypto options, and they are the premier platform. It's where you got to be if you want to trade crypto options. Hey, I'm not going to talk too much about us because we've got a lot of stuff we want to cover. And I want to get to it. But I do want to say, Richard and I have been trading for a long time. The 1990s is when I started trading. So I've probably been trading longer than many of you have been alive, and same with Richard. So we've got a lot of experience. We've traded every kind of market you can imagine, all kinds of instruments. So, knowledge is power, right? Now, what is this Deribit Live and what can you expect? Well, this is a co-effort to just help educate people in the crypto option space. Now, options are going to work the same, whether you're trading gold or stocks, or, options basically function the same. Now, there are some nuances with crypto, absolutely, and we'll discuss those over time. But we want to bring that knowledge of options over to the retail side of crypto options and for Deribit sellers. So one thing I do want to say is expect this to be very casual. I'll probably tell some stupid, corny jokes. Hopefully you'll laugh. Richard usually laughs at them. Basically, it's just, it's going to be like you're hanging. Well, sure. And that's okay. I appreciate that. But basically, it's like you're going to be here at the office with Richard and I. These are the types of discussions we have almost every single day. So just hanging out here with us in the office. But really, ultimately, we want everyone of all knowledge levels to be really comfortable, enjoy the chat, the analysis, and then have some really solid takeaways. I want everyone to have takeaways of both new knowledge and trade ideas or ways to improve their trading, whether that's your P&L, whether it's managing risk, whatever it is. I want to have some really solid takeaways. Now, the format we're going to be following is this. We're going to start off each Deribit Live with just sort of talking about the current crypto market, like what's going on right now in the crypto market. Okay, fine. And when I say crypto market, I'm talking about Ethereum, Bitcoin. I don't care about some shit coins or some little, subcent thing that's irrelevant for us because we're trading options. And we're going to talk about any current strategies or trades that we have on. We'll discuss those, how it came to be, how we're going to manage it, blah, 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 blah. Then we're going to broadly look at what we might expect the market to do in the very short term before we talk to you guys again a week down the road, and maybe some corresponding trades that we might be considering as a result of any market movements. Then we're going to move into an educational component. And this is going to be really, really interesting because this is where we're going to do our best to bridge the gap between what is institutional and sort of professional trader tactics to retail traders, okay? Because obviously most retail traders, they simply just don't have the capacity or the resources to do what an institution can do. That is just not reasonable, right? But what we can do is we can extract certain components out of those and apply them to the retail side with the intention, of course, making an impact on your bottom line. Finally, we'll have a little Q&A session. You can ask us pretty much any questions you'd like regarding trading. I mean, if you want to ask me what my favorite food is and stuff, we're probably not going to have time for that. But regarding trading, the one thing I will say is we're going to do our best to ensure questions regarding the material being covered are addressed first. So let's try to keep the questions on the material we're covering. If we've covered all that and you want to ask other questions about options trading, fine. We can cover those if we have time. In regards to the timing of the entire event, well, we're going to do our best to keep things to, let's say, 30 minutes of content, to leave about 15 minutes of Q&A. If we go over, we go over. I don't care. We don't really care that much. But we want to make sure there's adequate time for questions. So use the chat function here, no problem. We don't have a moderator with us today, so we don't have someone combing through and pulling things out for me for later. So I might miss some comments during the presentation. So if you have a question, you might be best off just to jot it down and then ask it at the end of the session when we have the Q&A. But feel free to drop in comments for any future topics you'd like to have covered. I'll do my best to catch up on all the comments at the end. Okay, first up. Now we have a poll here. Let me publish this poll, and I want to see where everyone's at. Very, very simple question here. There's three answers. Yeah. What's your level of options experience?
Yeah. We've got a lot of legendary traders with us. We're on it.
But are they really legendary, or are they just legendary in their own minds?
Well, we'll see if they pass the challenges we set them.
Yeah, okay. So little to zero. Hey, maybe you don't even know what an option is, or you've made a trade or two. Okay, fine. Intermediate, you've been trading for a little while. Maybe you know what gamma is. Maybe you can't recite it off the top of your head, but you've got an idea. And of course, legendary. You know what? You should be hosting the damn show if you're legendary, right? That's fine.
Yeah, we'll have them on here to give us their wisdom.
Yeah, that's for sure. Yeah. And, and really we need to know this because this is going to affect or it may affect some of what we share with you today. And it's going to shape the topics going forward. Because again, we're going to do our best to try and give a little bit of something for everyone as best we can in the time that we have. So it looks like we've got most of the people intermediate. And I'm actually not surprised.
Shane, someone's asking if the poll results are shown later. Does that mean that people can't see them yet?
Oh, they can't see them. I might have had to set that in the settings. My apologies if I did that.
Do you have to end the poll to like publish the results or something?
Maybe. Let's see how many people got on here. 1, 3. Yeah. All right. We'll just publish the poll right now. So just in case the poll disappears, I've never used the software before. Little to zero is around 30%, intermediate 55%, and then the rest around 10, 12% are legendary. So let me end the poll.
Can you guys see that now?
Okay, can you guys see that? I don't know if you can or not. Anyways, we've got half saying they're intermediate, and I'm not surprised because this Deribit sent this out to people who typically already have an account, so I'm not surprised we've got the intermediate traders here. All right. The next thing I want to do is let me go over to the chat, and I'm going to post something here. There. I posted at the top of the chat. There's a sign up link. Yes, this is our cheesy attempt. Sign up. Okay. If you don't have a Deribit account, you need to have one, right? Because how else are you going to trade options unless you have a damn account? So, or maybe you do have a Deribit account. Maybe you do have a Deribit account and you want to save 10% on fees. Because if you use this link, you're going to save 10%. Check out the link I just posted in the chat. Get that 10% discount. It's a big deal. 10% is a big deal. If you're an active trader, by the end of the year, that savings number really adds up and it's quite significant. So if you have an existing account, close that sucker, close that account, forget that account, open a new one, transfer the assets you're holding to the new account, and save some money for crying out loud. Okay.
Actually,
one last thing
on that subject. I run a. I'll show you in a minute. I run a retail account with the normal charging structure for testing out my systematic ideas, and I spend about half of what I make in fees every year, just out of interest. So 10% is a big uplift in profits.
That's a big number. And someone's saying, Ada's saying, give us 10% for existing account. I can't do that. I wish I could, but I don't have that ability on a technical side. Don't ask me how it works. All right. One last thing before we get started here. And this is very important. We did not know the level of knowledge of our attendees. We're coming in blind here. That's why I wanted to do this poll. But we did know that there were some pretty sophisticated traders on here. I had some names of some people, longtime traders. They know what they're doing. Really happy about that. So what we're covering today, we're going to go, we're going to go a little bit deep into some advanced aspects of options trading. We're not going to go crazy, but we are going to take you into a little bit of deeper water. Now, the point here isn't to impress you, with our knowledge or something. Rather, we wanted to demonstrate a very interesting concept. And the way we're going to present it, this is the only way we could do so. We had to go into a little bit of deep water. So I just want to reassure you, if you feel that you're in over your head, don't worry about it, okay? We're going to be taking feedback. We're going to be adjusting the content going so that no one is left behind. Now, that being said, regardless of how deep we go into any given topic, any given day, we're always going to try and ensure that in the end, there's always some easy to understand basic and actionable strategies. That's the point. We want you guys to come away with this, something you can actually use. Also, this being our absolute first episode, while we're normally aiming for 45 minutes total, this one's going to go a bit longer. I practically guarantee it. We might have little technical issues here and there, give us some time, to figure that out. But we need to put a little bit of extra content into this particular episode. So we're going to push past an hour of time. We've got some very important and some very technical aspects we want to drive home. And the final point here, and why we're going a little bit deeper and a bit longer, is we're going to blow some of your minds. We're going to blow your minds. And I will bet that 99% of you will never have even heard of some of the aspects of what we're going to show you today. It's completely counterintuitive. It runs completely contrary to sort of that accepted logic and teaching of how options work and the way you generate returns. You go into YouTube and find any talking head, nobody's going to be talking about this stuff, I guarantee. So with that very dramatic statement, let's get started. So let me bring up some slides here. And oops, I'm going to go back to the slides. Apologies. Go the other way.
Yeah.
Yep. I just want to make sure we're not got any funky graphics going on. Let me just adjust our heads here just so that we're not in the way, especially my big head. I'm going to put us down there on the bottom. Okay. You okay with that, Richard?
Yeah, it's fine.
All right, good. First things, we're going to look at the current market. And I've called this my silly chart. This is my silly. It sounds like a Monty Python skit for any of you old enough to know what Monty Python is. Can you show me the silly chart? Why do I call it the silly chart? Well, because all my technical analysis friends look at this, they say, what's this chart? It looks kind of silly. Because there's not much on it. They're like, where's your GANs? Where's your Fibonacci retracement? Where's your blah, 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 whatever technical analysis they're doing. The way I start to teach people about options, we don't need all that junk. If I'm trading near-term expiry options, if I'm gamma trading, sure, I'll have those on. You get this 5 minutes, the 1 minute, the 10 minutes, and sure, fine. We're not doing that. The way I teach people options trading is it's like horseshoes and hand grenades. We just need to be close. I don't need to be precise, right? I just need to be close. So all I've done was, you can see here, I'm going to turn the whiteboard on. This is going to be fancy. You guys are really impressed. Got the channel here, right? Very basic channel. And I started doing this. I've been using the same steel. I haven't touched a thing on this for about 2 months because I started running this right around here. We had this run up to the top of the channel. So I said, hey, this is the top of the channel. We've been in this trend for 2 months now. It's ridiculous, right? We're just going sideways for a month. And what I did was I drew some lines. I said, look, we've got a little bit of resistance here, or sort of support. We've got some more support down here. And I drew a pretty little unicorn down there. I said, until we get down to the unicorn, I'm not laying on any major strategies. Volume is at an all-time low, or volatility. I'm not going to stick my neck out right now. Could I be selling some iron condors on each side? Sure, maybe some broken wings. That's fine. That's fine. Maybe. So all I've been doing, and let me clear this and turn this off, is I've been selling. You probably can't see my thing there. I've been selling some here. Let me change this. There, that's much better. I've been selling some 10 to 20 delta calls very lightly, a little bit every day, spread out through June. Last month it was all spread out through May. Now it's through June. Now everything's taken out for June 2nd expiry tomorrow. There's all been taken out, 95% profit, and I've been buying a little bit of protection down here. These low delta puts, just in case, because I can guarantee you one thing. I don't know what the market's going to do from day to day, but I guarantee you we're going to break out of this range. Is it going to happen tomorrow or 2 months or 2 years? I don't know, but I guarantee it will. And I think Richard did some analysis, and when we're looking something like every 90-something days, the crypto market moves about 12% or something. So we're in for a big move pretty soon if the old patterns hold true. So I'm not sticking my neck out. I don't have any strategies. And actually, this is a nice thing because we're starting this off, this very first episode, June 1st. I don't have any major strategies on. Yes, I've got some light calls I sold up here. Yes, I've got some light puts I bought down here. But it's just to earn a little bit of theta, a little bit of time decay premium each day. Nothing much. Just waiting. I'm waiting. I'm happy to sit on my hands and wait for something big. Could you be playing a directional trade out of here or a long volatility? Sure, absolutely you could. But volatility might stay low for 3 more months. I don't know, right? So anyways, my point, and I don't want to spend a lot of time on this slide because there's not really a lot to talk about, is we've been stuck in this darn channel for a long time. And yes, we're hanging out at the lows of the channel, but we're still in the channel. If I had to guess, I'd say I feel more likely we'll probably make a move down rather than up. But anything, news can happen tomorrow, right? China all of a sudden, gets rid of the yuan and makes Bitcoin their official currency. I don't know. Then we're going to go straight up. Trust me, we'll go straight up. But, for now, I'm not too worried about it, and I'm not monkeying with it very much. I'm just sitting on my hands and waiting. And it's a nice opportunity for us starting this series because we're starting from zero. I don't have any strategies on too much that I need to explain. But as we go through each week, you'll see that. So if we do get down to this unicorn level, I'll be laying some stuff on, and I'll probably be trading quite heavily if we get down there. And it'll depend on how we get down there. Is it one giant candle that scares the bejesus out of everybody? Or is it going to stutter step down there over 4 weeks? I don't know. Who knows, right? We'll see. But that will dictate what type of strategies we put on. So that is pretty much it for my market analysis. Again, horseshoes and hand grenades. I don't want to, this isn't a technical analysis 101 course, right? We're just going to look at some general support and resistance. Richard, do you have any comments on my silly chart?
I like the picture of your unicorn,
yeah. Okay.
And right. Yeah, so and actually, it's worth pointing out that Shane and I trade different strategies, and that's one of the beauties of options trading. There's like 1,000 different ways to trade the market, and I'm slightly more technical and systematic, and Shane's more kind of opportunistic in the way he does things. Shane, you're kind of a semi-believer in technical analysis, and I think it's just voodoo nonsense. So we've both got our own styles, and we both sort of make money out of the markets in different ways, which is kind of encouraging for anybody who is unsure which way to go. I can't remember in the rehearsals whether we agreed that I'd show my screen now or not.
Yeah. Well, I mean, yeah. So actually, and that's a good point. So I am more of a discretionary trader. And I'm mostly selling. 9% of the time I'm selling. Sometimes I'll buy. I'll take advantage of things when those opportunities present themselves. But I typically wait for stupid things to happen. I don't try to predict. I wait. The market makes a 12% move. I'll take the other side of that, whether that's a spread or however I do it, or I'll look for a bounce. So I'm kind of waiting in the wings for dumb things to happen versus having the dumb things happen against me. Because trust me, I've spent many years doing that too. So, but Richard does that institutional and programmatic trading. We're going to dive into that here in a second. Again, it's our job to bridge that gap. So, you're going to see that there's no way a normal retail trader can use Richard's institutional strategies the way he does, but we can extract components out of it. We can apply that to the retail side in such a way that most people can incorporate those strategies into their day-to-day trading to enhance returns or reduce risk or whatever. So, Richard, I'll let you take it away. I know you could talk for 3 hours on this, but why don't we just set the stage? Let people know kind of what you do day to day. Then we'll get to extrapolating this strategy in order to help us manage short option positions gone awry, because that was the whole point of this lesson, right?
Yeah, actually, okay. So here's one of my accounts. This is a personal account of mine. It's worth about $95,000. It was worth about $70,000 at the beginning of the year, and I trade this very systematically. I write positions, option positions every day, and I systematically hedge with perpetuals and futures. And actually, I have a robot doing that for me because that hedger is hedging every 2 minutes. If it needs to. So you can see that in the Bitcoin market, I've got positions on June, 9th of June, 2nd of June, 16th, 23rd, 30th, 28th, and 25th of August. And my positions, that one actually doesn't have any. Let's have a look. This 30th of June has loads of positions on it. You can see that I'm long a couple of puts and short a load of calls. I sold all these calls when the market was a bit higher, so they're all a bit cheaper than they were. I bought the puts when the market was a bit higher. So I had puts all the way. I was long puts from 28,000 down, and I've actually sold a few of those and cashed in as we've gone down through them. And I'll explain why later. So in terms of the positions I've got on, you can see that I've got a load of positions all over the place, and this is probably something that most retail traders wouldn't do because it would be unmanageable. But because I'm systematically delta hedging, I actually don't care about a lot of these positions. So I'll let them run to expiry, whether they're in the money or not. I really couldn't care less. Because I'm trading the shape of the volatility surface rather than the actual P&L of each option, whereas Shane tends to trade more the P&L of each option. While I'm here, I'll show you a couple of cool features that will come into play a bit later on. So the first is the volatility surface. That was here, trading tools. This is a cool little feature that Deribit brought to us a few weeks back. This is what we call the volatility surface. So those of you who've heard of Black-Scholes, the equation that defines an options price in a stochastic frictionless market. What's the word? Market has to be frictionless, stochastic, and continuous, right? It flows. The prices flow like water. Then you could theoretically use the stochastic means random. You could use the Black-Scholes equation to price an option using the historic volatility of that market. The reality is that markets, and particularly cryptocurrency markets, are not stochastic, they're not random, they're not frictionless, and they're not continuous. So we actually have to cheat, and we use a different volatility number for each strike and each expiry. And you can draw that as a graph, a 3D graph, and that's what you're seeing here. It's like a map of, if you want to know the volatility input for the Black-Scholes equation at any one strike or expiry, you can come and read it off this chart. And so one of the features here is that this area here, right there, 16th of June, 2nd of June, so that's showing us that tomorrow we've got like quite high volatility across the smile, and the day after it all drops down. That's because tomorrow is an expiry day, 8 a.m. expiry Friday. That's a weekly expiry, so market makers tend to mark the prices up a bit, and then they tend to drop for the weekend, and then so you've got this kink, and then it gets smoother as time goes out into the future. And I just wanted to bring your attention, if I just turn this around to this kind of shape, if you can imagine, if you take a slice through this volatility surface, it looks like a smile if you kind of squint a bit and use your imagination. And so another little area of the tools you can see on Deribit. Again, this appeared quite recently. I was sort of quite pleased to find this stuff. There's a whole load of stats on here that I tend to ignore, but these are showing you slices through that volatility surface. So for every strike on a given date, you can pick off the volatility for that strike. And you'll notice that there's kind of a smile shape. I mean, it's like a 2-year-old has drawn a smile, right? But, and sometimes the smile is smirking towards the puts, like the puts are higher, and sometimes it's smirking towards the calls. Today, all of the smiles are kind of biased towards the puts. That's kind of telling us that the sentiment of the day is, oh no, that one, third. Okay, so Sunday's smile is pretty even. No one's got any opinions about that. Tomorrow's smile is more towards the calls, interestingly. I wonder if because people are short calls and they're worried about a squeeze up. But generally we're seeing that the smile is tending towards favouring pricing the puts higher. So market makers are detecting flows of selling, and people are buying puts and selling calls, much like I've been doing and Shane's been doing, and that's kind of driven those prices that way. My analysis, just to let you in on some insider secrets, is that this smile shape doesn't really tell us very much about future moves, other than that certain times there are certain conditions where it does. But on the whole, cryptocurrency traders have the attention span of a goldfish, and 1 minute they'll be super bullish, and the next minute they'll be super bearish, and they'll have forgotten all of the good news they heard yesterday, and then the next day they'll forget all the news they heard, bad news they heard the day before, and so best ignored. But this will come into play a bit later on. So just remember that you've seen this. It doesn't matter that you don't quite understand what it really is if you don't. That's all I've got to say on that. I think we can go back to Shane, and then we'll come back and revisit this a bit later with a bit more relevance.
Mm-hmm. Cool. Okay. Looking at the smile, looking at the volatility surface. Again, you might not have a full understanding of what it is right now, but as you stick with us over these episodes we put on, we're going to refer back to that from time to time. And in fact, even next week, we're going to be looking at it when we talk about, just so you know, next week we're going to be talking about rolling out trades and some ways you might have never thought about rolling out trades before. Let's not get into that. But just having that basic understanding is very, very important. So let's extrapolate. So the topic of today was getting out of trouble, right? You got some short options position, maybe it's naked, maybe it's a spread, whatever, and you're in trouble. You're getting pressed by the market. You're feeling very uncomfortable. Let's jump into that right now, and let me set the stage so that we can go through this. So let me go back to our slide here, and this is a theoretical scenario, and we're going to use Bitcoin, not stocks, because we're all crypto option traders as well. We're using Deribit. This trade starts to go against us. Okay, so we've sold one Bitcoin naked call in this example, or you had some positions on and you're taking things off and you're left with this naked call. It continues to go against us. It eventually hits our strike price, our short strike price. We're going to look at this from a chart point of view, just for a broad understanding of what's, the price action and how that's happened. And then Richard is going to take you through, a detailed analysis of how we hedge this with futures in this particular situation. So here we are. And this is actually a Bitcoin chart. Now, I did change these numbers a bit here just to match up the 25 and 27,000, just for context and for the numbers to match up. But we have this, if you've been trading crypto for a while, we get these big moves and then a sideways channel for a while. Sometimes it lasts 2 or 3 weeks, sometimes it lasts a month, whatever. But this is no big deal. So we have this channel, and looky down here, we had, I'm going to turn the whiteboard on again. We had this poke down. And everybody got all excited. They're like, oh my gosh, the channel's broke. We're going down. Sure enough, fake. And what does it do? It actually goes all the way to the top of the channel. So what do? Well, we decide to sell a 27,000 strike naked call. In our fictional example, this expires in 14 days. Now, I'm not saying every time this happens, you should sell a 14-day. This is just for demonstration purposes. And you know what? I feel pretty good about this trade because I think the chances are this stupid thing is going to stay back in the channel, right? So we sell the call. We're feeling pretty good about ourselves. Let me clear this off and go to the next slide. And what happens? Oh my gosh, we were right. It comes back down. It's in the middle of the channel. So I'm patting myself on the back. I'm going to the store. I'm already picking out my next fur coat because I'm so smart and I'm going to collect all that premium, right? And one thing I will mention here. Normally, I'm not the type of trader to sell premium and let it go to expiry. Normally, I'll say, hey, once it gets 25% of that premium back, I'm going to buy it back. So if I sold something for $100 and it goes down to 75, I'll buy it back for 75. I'll put $25 in my pocket, away I go. Or at least I'll cover a third of it or half. Or everybody's got a different number. Some people 20%, some people 40%, whatever. Or they'll cover most of it and let 10% ride. That's fine, whatever you got. But those rules-based traders, the ones that are rules-based, probably collected their money and they walked away. But not us. No, we're too smart. We're smarter than the market. And we're going to ride this puppy all the way down to the bottom, and we're going to collect all the premium, right? Yeah, okay. Well, what happens next? Sweet baby Jesus. This thing goes up to 26,000. Oh my gosh, it broke through the top of this stupid top of the range. And you know what? Technical analysis 101, this prior resistance now turns into support. So now we're sitting here going, oh my goodness, what has happened? There's a good chance if this holds as support, we're going to continue going up. And what happens? It does indeed. It goes straight up. And now we are at the money. We're not very happy. Our short call is now at the money. It's gone from a negative 0.23 delta to about a negative 50 delta. Negative 50, if we're using delta as a probability tool, means we got a 50% chance. 50-50, it can go either way, right? And we're down money on this thing. We are down money on this. So here's the setup. Here's what's happened to us. Our beautiful trade has gone awry. Now we're in trouble. We're feeling the heat. So Richard can take us through a few things. And actually, just let me set this up. I just want to say a couple of things here first. This is a very common situation. We've all had this happen to us. And we shouldn't be selling naked calls. We have to face a decision, right? Most commonly, retail traders are going to sit on their hands until something happens, a specific event happens, and the market hits a trigger price, usually that short strike price, or comes within a range of it. Some people use the break even. I don't like that so much because now your money is your option is in the money and it's harder to roll. But let's just say that you don't do anything until the market hits your short strike price. Well, what are you going to do? You're going to roll that trade out, right? You're going to roll it out in time. Maybe you keep the strike price the same. Maybe you roll it out and up, whatever you're going to do. Ideally, you're going to do that for a net credit. You make some money at it, or for a flat, so it doesn't cost you anything. Or some people might just close that position for a loss and walk away and say, you know what, I was wrong. I'll take the hit and walk away. Now, when a trade is rolled, a lot of people say, hey, this is like buying us more time in which to be right. And in a way of speaking, that's true. We've taken the short-term pressure off, right? So if we roll that 27 up to a 29, well, the pressure's off. but it's more of a mental trick because we're not really buying ourselves more time. We're actually locking in a loss. We're closing that position and we're opening a new position with a credit, hopefully, that offsets the loss. And we're going to be using a little bit more margin when we do so. And there's a term in options trading, roll until you're right. So if it goes against you, roll it out. Goes against you, roll it out. Roll it out. You do it for 6 months, do it for 2 years. I don't know. Seems like a waste of time to do it for 2 years. And it absolutely is because there's better opportunities elsewhere. But you can roll until you're right. But that's only true to a certain extent because you're going to run out of margin eventually. So as long as your margin holds up, you can keep rolling. Okay. But if your sentiment changes, you're probably better off to take a loss and look for other opportunities. But that's a topic for another day. Now, next week, as I mentioned, we are going to cover some very unique aspects of how we roll positions and some different alternatives to what you might have known before. So instead of waiting around, waiting for that thing to hit our strike price, and we saw it when it went up to 26,000, that previous resistance at 25 now turned to support, and we felt, oh boy, there's a really good chance it's going to go against us. But we can take some preemptive actions, right? And by taking these preemptive actions, we're going to mitigate some of our risk, and we're going to make a future potential roll a lot easier to manage. And this is where I will hand it off to Richard for the technical stuff.
Okay, thank you. Just before I start, there's a little question there from Sandro Bohem. Thank you. Yeah, so what does it mean to roll a position? I'm mindful that a third of our audience here are absolute beginners. So in this particular example, we've sold a 27,000 2-week call and it's gone against us. So that 27,000 call is now worth more than we sold it for, which means that we are underwater. We've got negative instantaneous P&L and we're uncomfortable and we want to roll it. By rolling it, what we mean is we buy that position back and we sell another option at a later date at a higher strike. That means that we kind of move the risk up the spot ladder to a higher strike, and we give ourselves more time for that to be the right outcome. So we're kind of trading instantaneous decay and P&L with high risk for lower decay at lower risk. And as Shane mentioned, this trade actually another way to call this trade is it's a diagonal. It's a strategy called a diagonal. So you're basically buying a diagonal to replace the short call that you were short. And this essentially consumes more margin. So much like when you're playing the roulette table you're betting on black consistently, and you keep doubling your bet each time it's red, so eventually you're going to win a chip back as long as you don't hit the table limit. It's kind of the same. You're eventually going to win your initial premium, provided you don't run out of margin. I have a funny story about that. I actually did this on the FTSE 100 index in 2005, and I spent 6 months rolling the same position, only to finally have to take a £250,000 loss, which was back when £250,000 was a large amount of money. So it doesn't always work. And so what we want to do is teach you how to do this in a way that it is going to work. This is just some fundamentals. I've just cobbled this together on Google Sheets. What you're seeing is, imagine the price of a 14-day $27,000 call. So the strike is $27,000. The volatility is fixed at 50%, which is kind of normal for Bitcoin. And it's got 14 days to run. And this graph is a graph of the price of that call at any given value of BTC USD. So in Shane's example, we sold that call when BTC USD was 25,000. And reading off the graph, we can see that 25,000, the price of that, the theoretical price of that call is $313, and it has a delta of 0.23 Bitcoins. And what you can see is as the price rises, the Bitcoin price rises within the same day, the price of that call rises kind of exponentially. And in our case, because we sold that call, rising prices equals pain for us because we'll be losing money. And the red line is the line of the corresponding delta, the rate of change of that blue line. And you can see how the delta quickly gets steep at around $27,000. And so that, think of, as the market rises, our 27,000 call becomes a car crash, and the more the market rises, the faster that car crash is approaching us. So I'm now going to go to a close-up of one section of that blue curve. And just, and I appreciate beginners here are going to find this a bit of a hurdle. So we do have a course in the Rogue Traders to take you through step by step. I want to just let everyone know, I've been trading options for 20 odd years. I'm quite good at it, if I say so myself, and I've never done anything higher than high school. I've never done a degree. The only qualification I have in my life is a helicopter pilot's license. Everything I've done is self-taught or having learned hands-on by working in investment banks and so on. And I'm a professional trader, and I'm paid by institutions to trade their money, which I do well and successfully. Literally anyone can do this. It's not hard. So that being said, so I want you to imagine what happens to the price of our 27,000 call as the underlying market moves from $25,000 to $26,000. So the black line, follows the market move, and the red line is the increase in price of our option, i.e., the increase in our pain. And in that move of $1,000 of the underlying, the option has increased in value by I forget how much it was now. It's gone up to about $600, so it's doubled in price, right? And the delta of that option was, or the delta of that move in price is 0.138 bitcoins. So in a way, being short that option, it was kind of the same as if we were short 0.138 bitcoins and the market moved against us. I.e., we'd sold 0.138 bitcoins, market moved against us, and now we're facing a loss. And at that price of 25,000, 0.138 bitcoins is $2,974 of perpetual. So whether we were short the option or short the perpetual, same result in terms of our P&L. Okay, I can go to the next slide. And then as the market rallies another $1,000, notice how the red line is the same size. So I'm just comparing. Notice that the option price has increased more in the second $1,000 than it increased in the first $1,000 of market rise. And so, in fact, so for the second sort of march up, it's as if we were short an extra 0.151 bitcoins of perpetuals or futures, which is equivalent to being short $4,500. And what you're seeing here is the effect of gamma. So if we were to try and hedge this, what we could say is, well, if the market's at $25,000, I could go and buy $3,000 or $2,974 of perpetuals, and then when the market rallied $1,000, the underlying move from 25,000 to 26,000, I wouldn't have cared whether that my option has decreased in price. So, has increased in price, because my perpetuals will now have unrealized profit to the same value. So being long 0.138 bitcoins at 25,000 will mean that when we get to 26,000, I've still got the same zero P&L. So I'm in a comfortable position. Now, buying 0.138 bitcoins at 25,000 because I'm certain that the market's going to go up is a kind of dumb thing to say, because the reason that you trade options and don't just go long futures is because we don't know the market's about to go up $1,000. If we knew the market was about to go up $1,000, we'd all just go and remortgage our houses and dump it all on long perpetuals, and we'd just be billionaires. So I'm going to turn on the drawing tool. This is probably going to be a disaster because I'm terrible at this, but what I want to show you is that, so here we've kind of, hang on, draw thing. I can't draw. It's not letting me draw. Embarrassing. black, pen, line, not working, never mind. What I'm trying to say is that you see the black arrow and the red arrow form two sides of a triangle, and you can make that triangle as small as you like. So actually what you could do, and if you're someone like me, like an institutional trader, what you'd actually have is a robot that would, every time the market moved, say $100, it would actually go and buy some perpetuals. Or if it moved every $50, it would buy some perpetuals. And it would buy enough perpetuals to compensate for the new delta that you've got for that position. So if you're like a market maker and you want to stay totally delta neutral because you're just trading the spreads on the options, or if you're like me, you're trading the surface, the vol surface, you want to stay delta neutral, your robot's doing that for you. It's continually buying and selling perpetuals or futures to keep you delta neutral all the way up this curve. And the more often you do that, the closer you'll fit this blue curve, and the less you'll lose in sort of hedging error. However, you will also spend a lot of money in transaction fees. So in general, by buying and selling some perpetuals in order to reduce your delta, you are limiting the impact of the increase in price of the option going against you. Now, how often should I delta hedge? Great question. If you want to control the delta aggressively, then as often as possible. If you want to trade pure volatility, that will mean that you are crossing the spread, and you will be paying taker fees very often. But it will also mean that you're closely fitting that curve and suffering less slippage or hedging error. Now, that's my world. Your world may be different, because I'm hoping that as well as trading, you guys have got day jobs. Some history for me. 2003, I turned 50,000 sterling into $1 million in a year, and decided that I was a living god. Gave up my job with some very choice words to the people I worked for, who I hated, and thought that life was going to be easy. What I realised later was I was actually just lucky, and so I had to learn some risk control and go and get another job. However, so my advice is keep your day job. Be nice to your boss, even though you're making more money than him. Let's assume that you only have enough time in the day to trade once a day. And actually, by the way, I'm a systematic vol trader. I've done the maths and I've done the back testing, and I can actually make money even systematically, just hedging once a day. I'll make more money by hedging more often, but I can actually on average make money just hedging once a day. So we don't have to be hooked up to computers to make money out of options, particularly crypto options. There's plenty of money on the table. Okay, so I'm only trading once a day maximum. Actually, delta hedging does still work when you're trading done daily. There are a few techniques about the way you write your positions to make sure that will work. Your returns will be a bit more lumpy or volatile than they would be if you're trading for a hedge fund. That's fine. When you're trading your own money, you don't need consistent returns. You are fully aware of the shape of your book. If you suffer a 10% drawdown and you deem that that's fine because it's all going to come back because of time decay or whatever, then you just live with it. You do that on a hedge fund, your customers are going to get scared. So I, in my day job, have a lot more constraints than you do about the way I trade. So I have to be a bit more aggressive with my hedging, just so I don't frighten the people who are paying me to trade their money. And I'm trading just volatility. You are trading probably a mix of the volatility and the market direction and time decay. And by hedging less frequently, you actually can pick up a little more value if you're lucky than I will. Okay. So is there a hybrid approach that allows you to only trade once a day, gives you a reasonable chance of keeping all the premium that you took for selling that call option, lets you take the risk on staying short delta into a rally, or short vol into a rally, doesn't cause you to lose sleep at night or take big losses, and doesn't add too much downside risk. So another thing I want to say is that, again, I made loads of money when I first started by overtrading. These days I'm happy with like 50 or 100% a year. Back then I wanted 10x a year at least, because I was young and stupid, right? But I used to wake up in the morning literally with heart pain at the age of 35, and that's not something that you can live with very. It's not actually something you can stay alive doing very long. You want to have a good relationship with your family, your boss. You want to think about your work when you're at work, your play when you're at play, and your trading when you're trading. You don't want to be living your book while you're doing all the other stuff. Trust me. Right. So here's the problem. I sold a 14-day 27,000 call when the market was at 25,000. I collected $313 in premium, which I'm going to assume is going to be mine in 14 days. But now the market is marching up and has reached $26,000, and I have to go to work or go to sleep or have dinner with my kids and be a good father. Right? And maybe I did this in some big size that I shouldn't have done. And now I'm feeling that horrible feeling in the pit of my stomach. I'm sure we've all been there, right? So I'm going to come into the detail later, but on the whole, step number one, here's one way of hedging it. When you feel some discomfort, so at the time when you are at the point where you're feeling in the pit of your stomach, that horrible feeling of why am I here? I remember the words of my mentor, Keith Williamson, who was my first options broker, who taught me to trade. And he said, what did he say? Better to be out of the market wishing you were in than in the market wishing you were out, right? So there's that feeling associated with this stage. As soon as you feel that fear, that discomfort, buy some futures or perpetuals. It just takes the edge off, right? Having bought some futures, you have mitigated some of the risk. Yes, you've kind of locked in some impermanent loss, but don't worry about that for the minute. You've taken some action, and what you now need to do is wait and sit back and just assess. Don't let your fear drive you. Don't go buying the option and then regretting it and selling it, or buying the option and thinking it wasn't enough, go and buy some more. You just wait. Time decay. You've sold an option. Time decay is working for you. You're still out of the money, and there's also a concept called delta decay, which is helping you, which I'll come to later. Step three. Okay. Time passed, and the market is carrying on its relentless rise. And as Shane mentioned, I think in our data analysis, we found that Bitcoin rises in like 15% a day, every 1 day in every 100 or something like that. So pretty often, if ever you've played role-playing games or XCOM 2 on the computer, 1% chance turns out to be quite a big chance if you roll the dice often enough. So sure as eggs are eggs, three times a year, you're going to get something really nasty in the market and that you've got to deal with. You've just got to be prepared for that if you're going to trade crypto options. So when the calls are at the money or just in the money, okay, and it feels like the market's going to carry on, or even that we're just not comfortable where we are, okay, maybe we were wrong, and actually we don't like this position. Maybe we want to be at a higher strike, or not fully on calls, or whatever. So it's time to roll the position. We're going to take the view on this that we're going to roll the position because we think we can get that premium. We're just going to say, okay, it might take me another week to get it. So we'll roll that position to a higher strike at a later date, and I'll come back in detail about what that is. And having done that, we're then going to decide whether we keep that future in place or whether we actually sell it and take the profit of it to take the edge off that roll. Okay, so I'm now going to. Sorry, I've forgotten written this slide. Hybrid approach through trade acceptable. Okay, so let's plan to roll a position that's going wrong as before, and let's take a small future position to help us. Right. So here is my awful graphics. So my apologies for this. When we get a bit more successful, we'll hire some graphic designers to write these things for us, draw these things for us. So on the left of the chart, the market was at 25,000 spot, and then it moved up to 26,000. And we started getting a bit sweaty about our 27,000 calls. I always write a short call as a red arrow pointing down. I write a short put as a red arrow pointing up, and green for long. So we have that short call is now worth $610, and it's now at minus 0.37 delta, whereas it was minus 0.2-ish delta when we sold it. And so we've currently got like an impermanent loss of about $300. I say impermanent because that money is still available to us in time decay if we hold out for 14 days or close to expiry. Okay, so what do? Well, we feel it's getting a bit sweaty. So we think to ourselves, I attended a Rogue Traders Deribit presentation on this. I know exactly what to do. I'm going to ease the pain in case this rally doesn't stop. I've got a life to live and I don't want to be spending my life worrying about this short call. So I'm going to buy, I don't know, finger in the air, 0.2 delta of perpetuals. Now 0.2 delta at 26,000 spot comes to about 5,000, well, exactly actually, $5,200 of perpetuals. And now my net delta on this entire position is the minus 0.37 delta of the short call plus my 0.2 delta of my long perpetuals. So my net delta is now back down to 0.27, negative 0.27, which is not far from what it was when I actually first sold the call. So I was happy with a 0.2 delta position down at 25,000 spot. So I really ought to be happy with a 0.2 delta position here, right? So I beg your pardon, it's net minus 0.17, about 0.2. Right?
0.1, yeah, I was going to say 0.17. And I think another good point here to make too, Richard, is that you're not hedging the whole damn thing right away. You're not hedging what Bitcoin, right? You're just taking a piece, and that piece is arbitrary, whatever you feel comfortable with.
Yes, that's right. And it's kind of arbitrary, yeah. But you'll get into a system that's comfortable for you. We all have a rule of thumb but in this case, roughly half, good enough, right? Okay, what happens next? So remembering step 2 of our little cheat sheet is we wait. We go to work and we forget about this stupid nonsense and we live our life. So then we come home from work, hoping that the market has settled down, but oh no, the market is relentless and it's definitely determined to go against us and make us pay for having the audacity to sell that 27,000 call. So, well, what do we do? Well, we mentally decided that we were going to roll that call when it hit the money. You will all have your own sort of rule of thumb I've often used in the past is if it goes in the money and then out of the money again and then back in the money, then I'll roll it. But actually, I'm going to show you a little bit later on why rolling out the money is probably a good idea. Anyway, so the spot market's gone up, now pushed on up to 27,000. So we've now gone up $2,000 in a day. That's pretty relentless. And, the news feeds are all saying, oh, Bitcoin's going to 1 million, we're all going to the moon, all that nonsense. So we're starting to really feel the fear now. But, that fear has been taken off because we've been now long a perpetual or future since 26,000. We've been long 0.2 delta or $5,200 of it. It's now at 0.19 delta that perpetual because it's measured in dollars, not bitcoins, because it's what we call an inverse future. You'll notice, I think, if you look at the Deribit newsfeed, that they're bringing out linear futures very soon, which will be a lot more helpful for this kind of thing. Our short call's now at $1,000 with a minus 50 delta or minus 0.5 delta, but actually our net delta is still only minus 0.3, and we were happy when our net delta was minus 0.2 when we first sold the call. So we're not too unhappy with the minus 0.3 delta. We're kind of, this isn't too bad, right? But we still think, what, the news and the sentiment and everyone's buying and all my friends and the taxi drivers are asking me whether I should buy Bitcoin. So yeah, it's going to go up. I don't like this. Let's roll this position. Let's get rid of it. But let's see if we can keep that premium. Let's be greedy. So what we're going to do is, in this case, we've decided to roll the position into a strangle and liquidate the futures to collect the cash. So I'm going to buy the 2-week call to close, and I'm going to that's the 27,000 call to close it, and I'm going to sell the futures to close it. So I'm going to realize the loss and realize the profit, and then I'm going to go and sell a strangle at let's say 3 weeks at say $28,000 call. It might even be $29,000 actually for a 0.2 delta, and I'm going to sell a short put at the same time, and that will be at say $25,000 because I think we've left that channel behind. And I'm going to collect a bunch of premium, and hopefully what I'm going to do is spend $1,054 on my short call minus the $200 I collected in my long future. So I'm going to spend a total of $800 to close off my 2-week position. And I'm going to go and write or sell options in 3 weeks. That's going to bring me back that $800. So net, I haven't lost or made any premium. I've just rolled the position for a net zero. And I feel that that strangle is pretty comfortable. And you'll notice that I will also buy a 10 delta long put because we never sell naked puts. You are a retail trader. The law is you do not sell naked puts. I'll tell you why. I'll tell you ad nauseum why. You'll get sick of hearing why. Anyway, we'll sell this strangle, and for the beginners, for those 33%, strangle is when you sell a call and sell a put. You sell the call at a high strike, you sell the put at a lower strike, or you can buy them. So it's a long strangle or a short strangle, and they're at the same expiry. Now, it's worth mentioning that this example is about hedging a naked call. You shouldn't really write any position naked if you're retail. And even if you're institutional, you should be thinking really carefully about writing naked puts. Anyway, yeah, I want to go back. So I just wanted to say that if we had not bought the future, we could have still rolled this. But in order to roll this position without the future, we'd have had to have found $1,000 of premium in the 3-week strangle, which means we'd have had to make that strangle tighter. The call would have had to be lower, the put would have been higher, and that 3-week strangle then has a bigger probability of getting in trouble. So by having the long future and that aid with the P&L, we've got a $200 smaller problem to deal with. We can afford to make our strangle wider in the 3 weeks, and we've now given ourselves a higher probability of collecting that initial $300 without damage. Okay, a bit about selling naked puts. Right. It's like the joke, isn't it? Why the long face? Said to the horse. Anyway, why the long put? Because A, you're a retail trader, and B, you have a life, and C, you probably don't have an auto hedger like I do. And that's a bit of software that sits and watches the market and hedges every so often. Mine hedges several times an hour if it has to. It just literally trades futures for me, so I can sleep at night and never have to worry about the market. Even if you did have an auto hedger, one day the market will gap down and kill you. And I'm not joking here. If Bitcoin gaps down by like $5,000, it'll do it in a minute or a second. And even if you've got an auto hedger, it will not get a chance to trade futures to manage your delta, because there'll just be a gap. There'll be no liquidity in the futures market, and you're just going to take a loss. And not only are you going to take a loss because the price of your puts has massively gone up, you're also going to get a volatility spike. So you're going to get massive Vega risk. And so vols are going to go from, say, 50 vol to 150 vol. So your puts are going to double in price because of the gamma or the delta. And then they're going to triple in price again because of the Vega. And then Deribit are going to get scared, and they're going to put the margin limits down. And then you're going to be on margin call, and you'll be closed out, and you're done. Okay, and I don't want
get the double whammy.
Yeah, and I don't want you to get. There's no reason to ever get liquidated in options. Options are the safest way to trade any market. Don't believe anyone who tells you that they're dangerous. They're only dangerous in the same way that guns are dangerous. If you point them at your own face, they're dangerous. If you point them at somebody else, they're not. Right. So here are the rules. Retail traders must not sell naked puts. I'm going to label that with a little rhyme, which I stole from my aviation days. There's an old rhyme that there are old pilots and there are bold pilots, but there are no old bold pilots. And similarly, there are old put sellers and there are bold put sellers, but there are no old bold put sellers. So let's not be bold. And let's not beat about the bush. Deribit wants you trading because they earn fees from you, so they want you to stay alive. We want you to join the rogue traders and pay us, so we want you to stay interested in trading. So we want you to stay alive, and you want to make money, so you need to stay alive. So it's in all of our interests for you to hedge your naked puts and turn them into covered puts. So please don't sell naked puts. Okay, before I go on, there are some other outcomes of this. So let's say the market hadn't got to 27,000, it could have petered out the rally at about 26,000. Okay, then we've picked up a couple of futures. They haven't done much. We can pick up the premium from the P&L from the future. If it pieces out at say 26,500, we can pick up $100 of. Oh, good question, Muzamil. So actually, as a retail trader, I would strongly advise you to not sell naked calls either. We'll come to that. But as an institutional trader, I'm actually okay selling naked calls because markets.
Yeah, let's keep all questions to the end, guys. Well, just keep loading them into the Q&A section, and I'll keep track of them, and I'll make sure we cover them all. Yeah.
But in a nutshell, Bitcoin will rise 20% in a day, but it will do it in a continuous march throughout the day. So you can sit there and hedge it all day. If it drops 20% in a day, it's going to go in a massive free fall that it's impossible to hedge. That's the reason. So the market softens at say 26,500. The 7 days pass. That premium comes out of the option. We buy the option back. We're all happy. We can take the profit from the future. We're good with that. Market reverses. Well, now we're going to keep the premium from the call we sold, but we might suffer a small loss from the futures. That's fine. We can sell more calls against that future. We can do covered futures. We can incorporate that future into another strategy. On our courses, we have a whole bunch of strategies you can do. It never hurts to be long a little bit of futures, as long as you've got a stop loss in place. And we can figure out a way to sell calls against that future to aggressively win that loss back. We can get 100 backs back, no problem at all. And then there's the third outcome is that actually the market suddenly reverses and dumps like $5,000. Well, yeah, so we need to have a stop loss on that future. Maybe put that stop loss at 25k, something palatable, whatever's right for you. We could sell a long-dated risk reversal, which is where you sell a call and buy a put. We could buy a long put, maybe a long-dated long put. We can do all kinds of stuff. There's a whole chapter of stuff we can get into there, and we can cover that in our courses. Okay, so that was the easy mode. So I'm sorry for anyone in that 33% who found that unfathomable. So now I'm going. I'm going to really lose you. But these are terms you should be aware of. And those guys who were intermediate, I'm going to educate you now. And those guys who told us you were legendary, then I'm going to bore you with stuff that you already know. Okay, so there are two more things about this. I'm going to summarize that as A, the smile smiles with you, and B, delta decay is your friend. And I'm going to teach you how to trade like a pro TM in 2 easy slides. It really is that simple. I'm going to sort of put the sum total of all expertise in all the hedge funds in the world into 2 slides, and these guys think they're elite, right? Okay. So you may remember that I showed you the options tools right at the beginning that are available on the Deribit screen. And 2 days ago, I did a screenshot and cut out just one of those smiles from that page. And what this is showing you is ignore the yellow arrows for a minute. The green line is showing you the implied volatility of the options on the 6th of June, sorry, the 9th of June strike at each, expiry at each strike. So you'll notice that at the time I took this snapshot, the market was around about 28,000. And if you notice on there if you look at the 28,000 strike, you'll see that at the money, or the 28,000 strike option has the lowest implied volatility, and because it has the lowest implied volatility, it has the lowest kind of relative price according to the Black-Scholes equation. In this case, it's about what, 41 vol, 41%, or we would call it 41 vol. And if you look at the, say, the 32,000 call, which on that date would have been, I don't know, probably 10 delta or something like that. You can see that the reading off the chart here. I'll see if I can actually get this thing to color. Oops, I can't make it work. Not worry. If you just read off the chart.
It's probably because I was sharing the deck.
Oh, really?
Yeah.
On color, I don't know, color green. Let's see. No, it's not working for me. Don't worry. If you can just read off on the 32,000 strikes, so read along the bottom so you find 32,000 calls. Read up and read off the graph, and if you look along, you'll find that that's trading at about 54% vol. So about 54 vol. Okay. Now I want you to imagine in your mind what might happen if the market moved up $2,000. So if the underlying market moves up $2,000 on this chart, that means the price of Bitcoin moves along to the right. That yellow arrow, of course, at the bottom, the price of Bitcoin increases, and that kind of has the effect of shifting all the numbers to the left. So all the strikes will move to the left by $2,000. And that means that if you follow these yellow lines down the slope of the curve, you'll see that the 32,000 call will now be priced as if it was the 30,000 call. And the 30,000 call, if you read it off this chart, is actually trading at 44 vol, or 44% volatility. So as the market has moved up, the call option that you sold at the beginning was priced at 52% vol. Now it's being priced at 44% vol. And on a relative basis, that means that the price of that option has become 25% cheaper than when you sold it. Now, don't get me wrong, the option is still more expensive because you're closer to the money, you're now at the money, but it's now being priced as if it had been written at 44 vol, not at 54 vol. And what that actually means is, if you were to dynamically hedge your delta as that market rode up, you would actually make money. You'd actually make 10 vols of profit, ignoring transaction fees and spreads and so on. But you'd actually make money. And this is actually one of the ways I make money every single day. So it might surprise you to learn that if you're a retail trader and you sell calls, you're kind of hoping that the market's not going to go up. When I sell calls, I'm hoping that the market is going to go up because I can make a ton of money out of that.
And I just want to interrupt you, Richard, and drive this home, because every single person, you will not hear anybody say that anywhere else. Everyone knows, Richard. Yeah, I don't know if you're trying to fool us here, but everyone knows if I'm selling volatility, I want the price and the volatility to come down, ideally both, and I want to buy that back at a lower price. We're the retail trader side, we're looking for theta decay, the time decay. And we're looking for that to decrease. But you, if you're doing this hedging strategy, you're actually looking for that to increase up to a point to get at the money. And I think you're going to cover that. But this is extremely counterintuitive. This is not what anybody understands or thinks. And this is what you do every single day.
Yeah. If I've sold a 1 week call at, like, I don't know, 10 vol, 10 delta, and we get a rally and I get at the money, I am celebrating. Right? It's just free money for me because I'm hedged all the way up.
We'd be crying. Yeah, we'd be crying.
You'd be, yeah. And so and I know that I hedge minutely if I have to, but this is also part true if you're hedging daily. So if you are only able to get to your keyboard once a day, this actually still works. Now you still want to avoid things like being risk concentrated, because this works on average for you if you're hedging daily rather than every time, but it tends to help you. And so it's worth just knowing that this phenomenon helps you. And whenever there is a positive smile, which there tends to be on any market, then in general, hedging early and hedging often is always to your advantage. And this single piece of knowledge is what will distinguish you from the majority of retail traders who lose money when the market goes against them, and help you to become one of those retail traders who make money all the time, and will therefore keep you alive, make your account bigger, make you trade bigger size. You're going to make Deribit happier, you're going to make yourself happier, and you're going to make the local Ferrari dealership happier too. Just don't buy it on credit. I've got a story about that. And there's something else about this graph, which is if we're saying that the option is getting relatively cheaper, that you can think about, the way I visualize this is that option is walking down the smile as the market's marching up. It works on puts, by the way, as well. It works in reverse on puts. The time when that option is at its minimum volatility is when it's at the money, which kind of says that it's the cheapest it's ever going to get. It's not on a relative value basis, it's at its cheapest it's ever going to be when it's at the money, which kind of implies that the best time to roll a position is when it's at the money, because that's the time you're going to pay the least premium for it, or the least relative premium for it, as long as you've hedged your delta. Okay.
Right.
I think we haven't blown everyone's mind.
Yeah, and there's two factors here. We kind of went a little bit deep, because, and we said we're going to go a little bit long this session. This is longer than our normal session, but we do want to get to the questions, and we will come to your questions, everyone that I see seeing being posted. So we'll carry on from here.
Okay. Okay, and here's the second thing: delta decay. And this is like one of those unseen things that you'll never think about unless someone mentions it to you. So on the right, I've taken a new graph, and this is that same 27,000 call when the market is at 25,000. But this time, the x-axis of the graph is the days to expiry. So when we sell that option at 14 days to expiry, we've got it worth $600. I'm pretty sure it was in the other graph. It was $300. That must be a different strike I'm doing. Anyway, it doesn't matter. And the blue line's axis is on the left-hand side, right? So and you can see that over 14 days, the option price will, if the market doesn't move, and again it's 50 vol, that option price will decay per day all the way down to zero as time expires. The red line is the delta of that same position, assuming again the market doesn't move. And do you notice how the delta is also getting smaller as time passes? What does that mean? That means that if we don't like being short 0.3 delta on day 14 with T-minus 14 or 14 days to run, and we prefer to be say minus 1.5 delta, 0.15 delta, on day with 14 days to run, we can buy 0.15 bitcoins of the future, and buy. So I beg your pardon. We're actually almost at 0.4 delta. So let's say we're not comfortable there. We buy I don't know 0.18. We halve the delta. Sorry, the axis for the red line delta is on the right hand side. Notice that after sort of 7 days have passed, that position's delta is now negative 0.3, and as time passes from over the 4 days, from 7 days to 3 days to run, that delta is decaying faster and faster. So that delta decays from minus 0.3 to minus 0.2. So if we were delta hedged, we could actually over those 4 days or 3 days, whatever it is, 3 days, 4 days, we can actually start unwinding parts of that future and stay just as comfortable as we were. So if you can imagine that you've bought the future at, say, when the market was at 26,000, the market's risen to 27,500, sorry, 26,500, and then a few days have passed and the market hasn't really moved very much, then actually we can start selling some of the futures at a profit and lock in those profits of the future without actually damaging our delta. And what this also means is that as time passes, that we've been hedged, or partially hedged with the future, our hedge gets stronger, and as our and so our P&L goes up. Our overall P&L goes up, both because of time decay and because of delta decay. So we actually have made money. So if we partially hedged ourselves, we've A, made money on the smile, and we've B, made money on theta, time decay, and C, made money on delta decay, so those are three good reasons why I have the edge and you don't, because I'm doing this and you're not. Right? So I sit there and make money out of the market sort of day in, day out. I'm being slightly facetious here because you might be a bit more sophisticated than this, but if you're a true amateur, you'll just write positions and hope for the best. And this is why I win and you don't, right? Because I've got those three things working for me. And actually, I'm lying to you. Actually, it wasn't two slides; it was three. Forgive me. So this is like a summary slide. No, it's not. This one is. 3 slides. Here's the summary. Okay, so here's the summary. My advice would be delta hedge early, the moment that you feel uncomfortable, and before you are at the money. Once you have a partial hedge, the smile is working in your favor. As time passes, your delta hedge gets stronger for any given moneyness because the delta decay is working for you, and of course, time decay is working for you. So therefore, being slightly underhedged is kind of okay. And the great thing about that is we don't have to increase our downside risk or our reversal risk. We don't have to get too aggressive too early with the futures. We just have to have them there behind us. And this will allow us to A, sleep at night, B, enjoy trading more because we're less, panicking. We have an easier time rolling bad positions because we've got extra P&L from that future, and we start to trade more like a professional and less like a headless chicken, right? And then, oh yeah, this was the questions.
Just so everyone knows, this is like one of the obvious questions that we always get. So I threw it in there right away because every beginner trader, every retail trader, the first thing they learn is I shouldn't say that. The first thing they should learn is don't sell naked. Just don't when you're starting. Just don't. Do it sometimes, yeah, but if you do it for 25 years, there's certain times when you feel something other people don't, you can do it, and then I'm prepared to manage that risk. But why not just do this as a simple, short vertical spread to start with? And I think we both agree there's nothing wrong with that. But over time,
more than that. Totally recommend that. Actually, so here, I've got an anecdote here, right? So I started trading in 2000 and I think it was 2. At the end of the Gulf War, I was trading FTSE options, FTSE 100 options. And I knew nothing about the mysteries of vol and skew and all that stuff. I just started selling iron condors on the FTSE 100 and started making loads and loads of money. And so I thought I was a living god. I then went and started leveraging up, and I turned ultimately turned £100,000 into £1 million. And lived like a lord for 18 months until I had sold vol down from like 30% down to 12% on the FTSE 100. And during that time, I got greedy because I was spending about a quarter of my premium on buying cover. I was selling iron condors, and I started getting greedy. Making £80,000 a month wasn't enough. Having 2 Maseratis on the drive just wasn't enough. Having a 600 square meter house, felt like I was living the life of a pauper. I made all the classic mistakes. I started mixing with properly rich people and just realised that millionaires just don't cut it anymore. And that was 20 years ago when £1 million was a lot of money. Now it's like, pocket change, right? So so I got greedy, and I actually started selling naked strangles because I just wanted that extra 25%. I was thinking, why should I give that up? So what actually happened there was two things actually conspire to ensure that you actually make less money doing that. So first of all, your margin bills go up, and your margin bills go up for two reasons. Because one, you're now short vol, and the span margin system that's running your margin can't see a way out if the market moves up by 30% or whatever their parameters are. So you get penalized on margin hugely. And secondly, the margin system looks at your Vega risk, which is the risk of volatility rising. And particularly in crypto, let me tell you, Vega risk is enormous. And Deribit I think they mark plus or minus 40 vol and I've seen vol go from 60 vol to 300 vol in one day. If you're short a book full of naked strangles on a day that happens, you're done. You're done. That's it. You're out. You're going to be liquidated, and your account's going to be worth like 10% of its value. You're going to feel so sick you're never going to come back. So you just can't afford to put on positions in the same kind of size as you could if you had actually covered your short calls and covered your short puts. So you actually make more money for longer. When you're selling naked strangles, you make more money for a short amount of time, and then you go bust. Or you make less money for the same amount of time because you know about Vega risk and you write smaller positions. So actually, if you cover your short calls and short puts, you'll make more money because you can get more risk on, because you've now got much, much lower Vega risk, and by the way, less gamma risk, and you've also got cap losses. And also, if you are going to hedge your the side that's going wrong with futures, your futures now have an automatic take profits level, which is the level of your long cover. So now you've got a situation where you can kind of dynamically trade your futures versus your spread, and it opens up such a world of opportunity for you that once you've done it once, you'll never go back to naked. So that's why you should hedge. Now I'm talking about a vertical spread, so that's selling a call in the same month and buying a call at a higher strike in the same month, for example. But that could be a calendar spread or a ratio spread or any other kind of spread. It's fine as long as you've got a mix of long and short. You'll have some cover for gamma and some cover for Vega, and no one ever talks about Vega except for professional traders, right? They never teach you about it in the beginner classes because they all think, oh, it's a complex subject. It'll turn them off. You need to know about Vega. Vega is what will kill you, particularly in crypto. And I guarantee, if you don't consider Vega in your strategies, within 100 days, I'm prepared to bet $1 million that you're going to be out and liquidated. I know that's true because I've got the stats. I've studied the back tests. I've seen every tick on Deribit for the past 4 years. I guarantee you that within 100 days, you're going to get liquidated. Here ends the second sermon.
Yes, there's a second sermon. Yeah, and you just don't do it. It doesn't matter. Like you said, Richard said, it doesn't matter how you set that spread. You could do a very simple vertical spread. Everyone nerds out. It's trading 101, right? Nothing wrong with that. But as you kind of understand these metrics a bit more, you'll find that they might not be as, well, I don't want to say as profitable, not as useful. They're very simple. They expire at the same time. You can walk away. You know you're covered, no problem. But when you start to understand calendar spreads, and then you start to dynamically, your short expiry expires. You're left with a long position. Interesting. You got that at a good price, perhaps. That's why we put it on. Now we can do things with that long. We can sell more calls against it. We can close it. It gives us more options. So one trade leads to another, and that's one other thing I wanted to mention about this is I wasn't implying that we just went out and just sold a naked call. Some people do that. Okay, whatever. If you've got that situation, well, here's how you can manage it. But sometimes you end up with a naked call almost inadvertently, because you're unwinding. If you've got lots of stuff going on, you're unwinding things. All of a sudden, you're like, hey, why did my margin go up? Oh, I got a big negative call there. Okay, well, what can I do? Well, you can close the darn thing if you want. Or hang on, maybe let's put a bit of a hedge on here. I actually like this position right now. I feel pretty good about it. And I'll manage it if it goes, if things go wrong, like we showed you on the chart. So a little bit on that. I don't want to go crazy. All these things are topics for another day. And again, I told you we're going to go a little bit over time today because we want to go deep. But in the future, we're just going to slice off.
We're already double the time, Shane.
Oh my gosh. Okay. Well, we'll just cook through then. But anyways, these are all strategies for another day. So I did want to talk about something here. Look, this might have been a bit of overwhelm. Okay. And I didn't want to freak out everyone. We didn't know where your experience level was at. Don't feel crappy if you didn't understand everything. Just understand the basic concept. That's where we start, right? If we're gonna learn, we've got to be outside of our comfort zone, right? So you're better to run with some bigger dogs, and you'll catch up and you'll figure it out. And we're here to ask questions as well. So that's where the magic happens when you're out of your comfort zone. So let's jump into the Q&A. But I do want to. I thought I had the slide up. Well, here it is. We got a couple really cool things for you. We've got this little giveaway we decided to do. Anybody who signs up today using this Deribit link, which is posted to the top of the chat, you can see there, where you'll save 10%. Yeah, we're just going to randomly pick someone, maybe the first person. I don't know. We're going to give them 3 months access to the Road Trader Academy and to our interactive real-time trade alerts channel. And what is that stuff? Well, I'll tell you in a second. First of all, I have to tell you though, I have 5 kids. Now, Richard's beat me. He has more than 5. And kids are like algebra. What you do to one side, you have to do to the other. So if you give one kid ice cream, you can't not give the other kid ice cream or something equally as valuable as ice cream. So you got to treat them like that. So I don't want to just give something away to one person. And this isn't a big pitch fest. It's just a very simple little thing here, but it's very, very powerful. We've got a special offer here, $7. $7. We're going to give you 14-day access to the Academy and to the live trade alerts channel. I mean, $7, that's like a fancy coffee at Starbucks. It's nothing. It's a no-brainer. Now, what is it? Rogue Trader Academy. Hey, we're brand new for the Academy. We got our Options Fundamentals course now, which is a big course. Most beginners take about 2 months to get through it. But the most exciting thing for both beginners and for experienced traders is the interactive live trade alert. So you're going to see all our trades in there on crypto. But the best part is you can ask questions. Why did you sell at that price? Why now? Why this vol? Why this delta? Why this expiry? Or you can ask about your trades too. To be clear, we're not going to give you trade advice. We're not going to say, hey, now's a good time to buy a Bitcoin. I don't know, right? We are going to help you understand if you've got a position on, you're like, hang on, I'm not sure what I've done here. Well, we can analyze that. We can say, well, you know what? Look, if the market goes up, this is what's going to happen. If the market goes down, this is what's going to happen. If it stays where it is, this is what's going to happen. You can decide. Then you'll have the info. And this is how people accelerate their learning curve, because Richard and I both had mentors. Yeah, sure, we were in the banks and professional trading floors and stuff. We still had mentors. Someone sitting there to look over their shoulder or to guide us. And I wouldn't have had the success that we had without a mentor. So I'm going to put this special offer here in the chat as well. But you can check that out. Hey, it's a limited time thing. I don't know if we're going to have it up for more than a day or so. $7, give it a try. We can chat with you over there. The other thing too is you better go on it right away, because Richard's taking off in a week. He's going to be on a supercar rally in Portugal hanging out with billionaires. And at that point, he's not going to want to answer your questions because he'll be having too much fun.
I'm around for the next week. I'm on this rally on the 14th onwards for a week. And if you take our course, you too can hang out with billionaires.
There you go. It's just that easy, right?
Dude, awesome. We're way over time. We should get to the Q&A because otherwise,
let's get there. And I will put this link in the chat too, so you can copy it. But Richard, let me go back to the first. Let me go to the Q&A questions here. Let me just go back a little bit. So, Ilona, wondering if you see anything in the volatility skews, et cetera, that correlate to what the market is thinking about future interest rates, or are crypto options uncorrelated to the stock and bond markets?
Where was that now?
That's the very first question, very bottom on the Q&A, on the very bottom.
Oh, yeah, okay. And don't excuse that. So, the correlates to what market's thinking about future interest rates. Interest rates tend to be baked into the option prices, regardless of the skew. They tend to be baked into the futures basis, the future spread over the spot. I think Deribit mark Bitcoin interest rates at 0, and then the prices on the synthetic futures at each tenor tend to reflect the cost of dollars. I think is how it tends to work. The actual skew doesn't tell us a lot. There's a few. So we've done extensive analysis on what the skew tells us. There are some signals I take from the skew. I actually take more signals from the underlying at the money vols. Interestingly, what the first thing the skew tells you is what people have read in the news today, and what they're frightened of. They tend to find that if it's all like, oh, $1 million Bitcoin is just around the corner, all that stuff, then the skew tends to be positive. If it's all like, oh no, the Fed's going to ban Bitcoin, then it's all skew negative, and any other time it's kind of roughly neutral. It's kind of been reverting. I actually trade the skew, so if the skew is strongly negative, I'll buy risk reversals, and if it's strongly positive, I'll sell risk reversals just to pick up a bit of trading, and I'll market make around that actually. And sometimes the skew does tell you something. I sometimes get the impression that market makers see the spot flow, or they know what orders are coming in, and dare I say it, they even mark the option surface prior to those orders being executed. So sometimes you can see from the skew that there's going to be a move sometimes, but the sortino of that's low, right? So I wouldn't try and predict anything from it.
Okay, just so you know, Richard, we only got 10 more minutes here, pal.
Sorry, dude. Yeah. Okay.
Yeah, no problem. And I do want to get to a few questions that are actually a little bit more related to the strategy, if we can help it here. So Mia, how did I say that? Mia Anelius? I'm sorry if I pronounced your name wrong. She did have a question earlier, and she said, other people are preaching sort of you enter on the 4 to 5 days to expiry, and then you're managing at 21. I've got no problem with that because it gives people a system. I like that. It's a system.
Yeah.
You take your profit here, you do this here. We don't do things that way. And in future episodes,
I do sometimes. Shane, I do sometimes. I'll sell that bit of the curve if I think that there's good vol at 40 days and low vol at 20. Sure, why not? Right?
If there's good vol, and I think that's a qualifier. So I've got no problem with that. I think it's great to have a system. It's better to have some system than no system, than just being willy-nilly. You got to have a reason, right?
Yeah. I mean, I do. I'll sell 2-month calls and strangles or condors. I'm generally not going to do that in a low vol environment, so I wouldn't be doing it now myself. But when vol's at 70, 80, yeah, sure, sell as many as you want.
Yeah, I like that. One other thing I'll mention too. So we added that little futures hedge when the price went from 25 to 20. It was going against us. We added a little hedge. I just want to say you can add that hedge when you initiate that position. So we sell a 27,000 call. We can just do a 0.1. We can just buy a little bit of the futures at that point, because as Richard demonstrated, it actually gets more powerful as the price moves up against the short call position. That futures has a little bit more weight. So that's an interesting thing there. You don't have to wait. And the other danger with waiting is crypto's 24/7. What if when you're sleeping, that goes from 25 to 29? Well, then you miss that opportunity to say, you didn't have that same time. So again, it goes back to that mantra. Really, you shouldn't be selling naked anyways. Have some type of cover on. So this was an example to show you how the futures worked. getting out of trouble if you were in a short position. Another question here. Do you often close futures at an offset realized loss? I'm looking to make a profitable gamma scalping DDH setup.
Do I sell options at a loss or buy them at a loss? Sorry.
Yeah, it's just saying you close the futures at an offset realized loss.
Yeah, why not? Look, because you're looking. The wrong way to trade an options book is to treat each position as a discrete position. You should be treating the whole book as an organic thing, and all you care about is the overall P&L of the book. You should never care about the individual P&L of each option. You should be totally caring about, is there any value in holding this option anymore? It's kind of like playing poker, right? So I was once asked the question by a friend of mine, what's the right time to fold a hand in poker? And it was kind of a riddle. And the answer is, the time to fold a hand is when you know you can't win. So what's the right time to sell a short option? When you know that there's nothing more to gain out of it, right? If there's no more juice to squeeze out of it, and all you've got is downside, basically staring in the face, get rid of it. And if that means you've got to close a future at the same time to keep yourself hedged, properly, you do it. You shouldn't care about the P&L of any one position, right? You care about the whole thing.
Sure. Just like if you sold a short vertical spread and it comes down, or the vol comes down and it's profitable, close up both sides if you want. It just, one side you're technically taking a loss, but it's part of a position. So, Rich, this is an interesting one. For a long vol, like your long option position, do you also delta hedge as often as possible? Doing so would keep you in a pure volatility position, but also guaranteed to pay the full theta bill every day, hence not helping your P&L.
So this is going to depend on what you're trying to achieve from your long position and from your hedging. There are many reasons to be long vol in a systematic trading strategy. One might be because you think vol is low and it's going to rise, so you're essentially just buying the volatility index. Another is that you might think that the vol is low here at one particular place on the vol surface and high somewhere else. So you might buy one part of the surface and sell another part to get the relative value. If you just think that vol is low, and actually another reason to buy vol is that you might think that the market is actually going to be directional and go and blast through your strike, right? So if you think the market's going to be directional and you're basically buying a put because you think the market's going to dump, well, then you kind of just don't delta hedge it, or you might delta hedge it, like market make around the delta for a couple of days while the market's flat, and then as soon as the market dumps, you pull those orders and just let it run. I actually have an automated strategy that I'm testing at the moment that does that. By the way, I think I delta hedge around about 2% from the mid for any one day, and if it blasts through that, we let it run for like 6 hours and then hedge again. That kind of stuff. We're experimenting with that. So it's kind of a hybrid. But if you're fully systematic and just trading vol, then you kind of theoretically want to hedge as often as possible. It's not quite like that, because you don't really want to hedge every single bump in the road, because a lot of the time the market moves around. In fact, on Sunday, our auto hedger I think it traded 200 times overnight, and ended up costing me all my time decay. So we actually slowed the hedger down and widened the tolerances a bit, because we don't really want it hedging more than about 50 times a day, really, or maybe even fewer. We kind of want it a bit more, intelligent. But if you're trading on institutional spreads and look, if you become a market maker for Deribit, they'll pay you to trade, right? They'll pay you rebates if you make. And so actually now, if you're making into long options and then market making the spot or the future around that delta or that gamma, then you can pick up, you can get paid for actually making no money.
Cool.
So because you're doing the market a service, right? So there's all kinds of tricks and reasons to do it.
We actually have one question here, Richard, about an auto hedger. We do have to go. We just got 5 minutes. One more question here. Is there an auto hedger as a service we can subscribe to? You built yours, so I'm not aware of any. But do you have any managed accounts you'd like to be passive investors rather than traders? We're
there's a
working on some
massive,
stuff there.
yeah.
Yeah,
So
maybe
the
you
answer
can
is
email
funny.
us.
Yeah. Listen,
Yeah,
yes, it could be done. We could do it. There's a couple of regulatory questions we'd have to answer first, because there's the issue then of who's trading the account. Is it us or is it you? If it's as a service, you could probably on the web find someone's Auto-hedger and download it or something. It's a topic of discussion within the road traders, and we'll find a solution to it. If you stay with us and stay friendly with it, we'll figure out a way.
yeah. Okay. And I did put our email address. You can email it in there, and we can keep you updated on things like that. If you want to message us, hello@roadtrader.academy. We can chat about those things. Guys, you know what? We're pretty much out of time here. I'm sorry.
Great question.
We've
I
got.
just want a quick prop to KD there. Great question. If you're a diamond handholder, it doesn't matter about selling naked puts.
That's right. Nerves of steel. I tell you, nerves of steel. Yes, a pro poker player. So I'm not surprised we're getting these folks in this. So, anyways, guys, listen. The next Deribit Live, I promise it'll be shorter as intended, and we're going to leave a little bit more time for questions. We do have to go. In fact, we're going to shut down here. The software is going to shut down because we've hit our time available. So we got to take off. So I just want to say that's a wrap. We covered a lot of ground. I'm proud of everyone who stuck around. We got almost everyone stayed here. That's very fantastic. A lot of new materials, a lot of new concepts for people. We definitely want your feedback on topics. You can always email us, hello@roadtrader.academy. For further topics you want us to talk about in the future. We're happy to do that on the Deribit Live episodes. With that said, one last mention there, that 14 days access for the $7 special offer we have for attendees. Do yourself a favor. Take advantage of that. I mean, we're here to help, right? That's what we're doing. We'll say goodbye. Please join us again for the next Deribit Live. We'll be discussing rolling options out, okay? Every option seller is going to need to know this or deal with it at some point in time. So it should be extremely valuable for everyone, a lot of fun as well. So good night, everyone, and we will see you next time.
Thanks for coming, guys.